Your favorite blue hoodied stockman here. Before we jump in, remember that this video is for educational and entertainment purposes only. Nothing presented should be considered financial, investment, tax, or legal advice. Investing involves risk, and you could lose some or all of your money. Market data and opinions may change, past performance does not guarantee future results, and any companies or assets discussed may be held by the creator. Always verify the information, conduct your own research, consider your personal financial situation, and consult a qualified professional before making financial decisions. Now let's get into it. The stock market just hit an all-time high, while interest rates are shooting higher, and somehow, both sides think they are winning. Stocks are celebrating like the recession was canceled, bond yields are flashing warning signs, mortgage rates are climbing, and the Federal Reserve just experienced something we have not seen in a while. 3 officials voting for a rate hike. Wall Street is basically the "this is fine" dog right now, except the room is filled with treasury bonds, and the fire is charging 6.69% interest. So, did the Fed just reset the market, or are investors ignoring a financial trap hiding in plain sight? Let's break it down, and if this video saves you from panic selling your retirement account at exactly the wrong moment, hit the like button and subscribe for more investing content. As your reward, here is a majestic pony reviewing the yield curve. He has no financial credentials, but neither does your group chat. First, the Federal Reserve did not actually raise rates at its latest meeting. It held the federal funds target between 3.50% and 3.75%, but 3 policymakers wanted an immediate quarter-point increase. That disagreement matters because inflation is still above the Fed's 2% target, energy costs have been volatile, and the Fed is no longer debating only how quickly it can cut. A potential hike is back in the conversation. The Fed directly controls a short-term interest rate, but it does not personally choose your 30-year mortgage rate. Longer-term borrowing costs are heavily influenced by the bond market, where investors constantly reprice inflation, economic growth, government borrowing, and future Fed policy. In other words, the bond market can tighten financial conditions before Jerome Powell even reaches for the microphone. It is monetary policy's version of your parents saying, "I'm not angry, I'm just disappointed." The 10-year Treasury yield recently traded near 4.7%, while the average 30-year mortgage reached 6.69%. At that mortgage rate, a $400,000 loan would carry principal and interest payments of roughly $2,580 per month. At 3%, that same loan would be about $1,686. That is nearly $900 more every month for the exact same debt, and it does not include taxes, insurance, maintenance, or the emotional cost of discovering what a new roof costs. Higher rates hit more than housing. Credit card balances, adjustable rate loans, business financing, and new auto loans all become harder to carry. Companies with weak cash flow can also struggle when cheap debt matures and must be refinanced at much higher rates. That is where the real danger may be hiding, not in a dramatic overnight crash, but in a slow refinancing squeeze. Higher rates also changed the competition facing stocks. When cash paid almost nothing, investors had a powerful reason to chase stocks, speculative technology companies, real estate, and crypto. When treasury bills and savings accounts offer meaningful yields, investors can demand more compensation before taking additional risk. The risk-free rate went from
"You guys are getting paid?"
to becoming an actual option. That can pressure expensive stocks because their expected future profits become less valuable when discounted at a higher rate. But higher rates do not automatically mean stocks must crash. The S&P 500 recently reached another record because corporate earnings and optimism about future growth remain powerful enough to compete with those higher yields. Rates are one input, not the entire machine. Stocks can rise alongside high rates when economic growth and profits are strong. The dangerous combination is high rates plus falling profits, weaker employment, or a credit shock. And that is why the latest labor data deserves attention. July payrolls declined by 23,000, while unemployment remained around 4.1%. One report does not establish a trend, but it creates an uncomfortable split screen. Inflation remains above target while hiring shows signs of weakness. Housing faces a different problem. Higher mortgage rates reduce what buyers can afford, but they also discourage existing owners with 3% mortgages from selling. That low-rate mortgage is no longer a loan, it is a family heirloom. Limited supply can keep prices stubborn even while transactions slow, so affordability may worsen without producing the enormous nationwide price crash buyers are waiting for. Some local markets can absolutely decline, especially where inventory rises quickly, but mortgage rates up does not not automatically equal every home price down. The federal government is another major borrower affected by this reset. The Congressional Budget Office projects approximately $1 trillion in federal net interest costs for 2026. As older debt matures and is refinanced, higher average rates can push that bill upward. So who loses if rates remain higher for longer? Borrowers carrying variable rate debt, companies dependent on constant refinancing, highly leveraged real estate investors, and anyone buying an asset solely because they assume financing will become cheaper next month. But there are winners too. Savers can earn meaningful interest on emergency funds, short-term treasuries can provide income, and homeowners with low fixed-rate mortgages remain insulated from rising market rates. Patient investors may also get better opportunities if volatility forces excellent companies to trade at more reasonable prices. Here is the practical game plan. Number 1, eliminate or refinance expensive variable rate debt where doing so genuinely lowers the total cost. Number 2, keep emergency cash somewhere competitive instead of allowing it to earn almost nothing. Number 3, stress test major purchases using today's rate, not the rate you hope will exist next year. Number 4, when evaluating stocks, examine cash flow, debt maturities, profit margins, and valuation, not just an exciting ticker symbol followed by 3 rocket emojis. Number 5, stay diversified and avoid rebuilding your entire portfolio around one Fed meeting. Nobody consistently knows whether the next major move will be a hike, a cut, or another long stretch of waiting. The biggest lesson is that the market is not responding to a single switch inside the Federal Reserve. It is balancing inflation, jobs, earnings, oil, government borrowing, and investor expectations simultaneously. Record high stocks and rising yields are not a contradiction. They are evidence of a tug of war between strong profits and increasingly expensive money. If growth holds, the market may keep climbing despite high rates. If earnings weaken while borrowing costs stay elevated, today's record prices could suddenly look much less comfortable. So do not panic, do not become emotionally attached to a rate forecast, and please do not take portfolio advice from the pony. He is currently 100% invested in hay futures. Do you think the Fed will hike next, or will weakening employment force it to back down? Leave your prediction below, hit the like button, and subscribe for more investing content. Until next time, keep your debt manageable, your portfolio diversified, and your memes financially responsible. That's a wrap from your favorite blue hoodied stockman. Like, subscribe, and keep investing smarter. Until next time, stay informed, stay diversified, and don't let the market steal your hoodie.